MoneyShow.com is proud to present to you this exclusive webcast presentation from the Las Vegas Money Show. Thank you for watching. Enjoy the show.
Good afternoon. I'm Howard Gold. I'm the editor-in-chief of MoneyShow.com, and I'll be moderating this panel. One of our panelists is on his way, but I thought I'd just get started with the introductions and then get right into our discussion. This is the Bulls or the Bears, and I know this has been a very popular workshop at the Money Show for many years, and this is my first time I'm moderating it, so I'm really looking forward to it, and I hope you are too. Let me just start by introducing the panels. On my right are the Bulls, and let's just go right to left. Louis Navalier is the editor of Emerging Growth, Quantum Growth, Blue Chip Growth, and Global Growth. He is chairman, chief executive officer, and chief investment officer of Navalier and Associates. In 1980, he began publishing his research in the stock advisory newsletter, the MPT Review. Mr. Navalier has been broadly publicized, including appearances on CNBC, Bloomberg, the Nightly Business Report, and Wall Street Week, and has been featured in Barron's, Forbes, Fortune, Investors Business Daily, Money, Smart Money, and the Wall Street Journal. Please welcome Mr. Louis Navalier. Also with us today is Joseph Battipaglia, Executive Vice President and Chief Investment Officer for Ryan Beck and Company, a subsidiary of Bank Atlantic Bancorp. He is the firm's chief investment strategist and spokesperson on investment policy. Mr. Battipaglia is also the chief investment officer of Washington Crossing Advisors, which is Ryan Beck's proprietary investment advisory program. He is featured frequently in national media, including CNBC, and speaks regularly with reporters from the New York Times, the Wall Street Journal, and other publications where his market views are often quoted. It is truly a pleasure to introduce to you Mr. Joseph Battipaglia. Now, as we move on to the Bears side, I'm going to introduce Peter Schiff, President and Chief Global Strategist of Euro-Pacific Capital, a full-service NASD-registered broker-dealer which specializes in foreign securities. He is a recognized expert in the domestic and foreign securities markets, as well as the currency and gold markets. He speaks at major investment conferences, is quoted often in all the major newspapers and magazines, including the Wall Street Journal, the New York Times, Los Angeles Times, Barron's, and Business Week. His first book, Crash Proof: How to Profit from the Coming Economic Collapse, was published in March 2007 by Wiley & Company. Please give a warm welcome to Mr. Peter Schiff. And I'm going to introduce Marty, even though he's not here yet, to try to get that introduction done. Dr. Martin Weiss is the editor of Safe Money Report and the daily e-letter Money and Markets. He is the founder and CEO of the Weiss Group, which includes Weiss Research, Weiss Capital Management, Weiss Capital Securities, and the Weiss School. And there he is right now. Dr. Weiss is also the author of Crash Profits, Make Money When Stocks Sink and Soar, and the New York Times bestseller, The Ultimate Safe Money Guide. So please give a hand to Dr. Martin Weiss. Good timing. So I wanted to start off this first, and we were going to allow a lot of time for crosstalk, but I just wanted each of the panelists to very briefly give me your views of the markets, the economy, and the world from the point of view of investors. And let's just start, again, right to left with Louis Navalier.
Oh, great. On here? Okay. Is that hot?
Yes, we're hot.
Is it hot? Okay. Okay, now you hear me. Well, here's what's happening. Something odd's happening. Earnings are actually slowing down, and the economy's slowing down, but the market's been heating up. So I'd like to explain to you why that's happening. First of all, earnings aren't slowing that much. They grew for 18 straight quarters at 10% or more on the S&P 500 through the third quarter of last year. Fourth quarter, they slowed down to 8.96. The first quarter earnings are coming out now. We're running about 8.65. Now, why the market got excited and the earnings are slowing down is depending on who you talk to, they expected those earnings to be up 3 to 5%. They turned out to be at 8.65%. So earnings were almost double what the analysts expected. And one of the reasons earnings are so strong, two reasons. Record corporate buybacks, which restrict the earnings per share, so that boosts earnings, and the weak dollar. The weak dollar is a windfall for all the multinationals. So the McDonald's, the Colgate-Palmolives, the Reynolds American, the Procter & Gamble's, the Cokes, all get extraordinary earnings from a weak U.S. dollar. So that's the good news. The bad news is the economy is really grinding to a halt here really quickly. We slowed to 2% in the third quarter, 2.5% in the fourth quarter. The first estimate of the first quarter is 1.3. Based on last week's trade numbers, they're going to revise it under 1. And this quarter's not shaping up very good because consumers are in a kind of a really bad mood right now. Retail sales were just hideous in April, and auto sales were horrific, even for Toyota and Honda. So what's happening is consumers are 70% of our economy. So in the midst of all this slowdown, why would the market be taking off? Multiple reasons. One is corporate buybacks are relentless, okay? A lot of that's because if you're an executive, you can pay yourself a salary tax at 35, or you can pay yourself a dividend tax at 15. It doesn't take very long to figure out 15% tax better than 35. So they like to buy their stock back, which boosts management's ownership, and then boom, here comes a dividend. Last 3 years we lost 506. Last 3 years we lost float. Companies are buying their stock back. All the mergers and acquisitions. Last year was $560 billion. We could lose $1 trillion in float this year. There's in Congress, they're proposing taxing these private equity guys at a higher rate, so that just makes them rush to do more deals faster. The final reason is that there's no ifs, ands, or buts. The Fed will be cutting. And the reason they're going to cut is they want the core rate of inflation to get down to a certain level. There is plenty of inflation in energy. There's plenty of inflation in food. But the core rate excluding that is getting down the level where they'll soon cut. So next 5 to 11 weeks, we've got a Fed rate cut coming, and Wall Street's fully anticipating that, plus market rates have come down. There was aggressive Asian buying last week, drove market rates down. Fed never fights market rates. So you have a Fed rate cut coming. So this is kind of the soft spot here. Looking forward, we're heavy utilities, heavy defense stocks. The market will be getting more narrow, more selective, but it's still a bull market. We'll be headed higher.
Let me just add to that where we've come from, because I believe we're up approximately 18% in the averages since we were last together here. So clearly it paid to continue to have a bullish orientation. Now, the bears will tell you that other markets did better. That's true. But I realize now why you use the bear as a symbol for a negative attitude, because when a bear hibernates, there's no one else allowed in the den. You never notice that? If anybody else tries to get in there, they kick them out. So I said last year that, look, there's room for everybody under this tent, and the fact that commodities were moving did not necessarily mean that everybody else is going to make money and the U.S. wouldn't. So here we are a year later, and the S&P is up some 18%. What has not been interrupted, to add to what Louis had just said, was the flow of trade and capital, globally speaking, as it relates to dollar balances held by foreign countries, the acceptability of our treasuries at these low interest rates. And because that relationship has not been unended, and no central banks around the globe are looking to take that on by doing something drastic, you have this condition now where multiples have become commonplace, risk premiums have been narrowed. That's not necessarily a lasting condition, don't get me wrong, but that's why we are at the point where we are today. And those flows of trade and capital continue unabated.
Okay. Anyway, well, first of all,